Good day and welcome to this digital version of the Celerity Investments Roadshow. It's the first time that we have done our roadshow in this way, and we've got the great privilege to be in Coronation's offices in Claremont in Cape Town. With me today, I've got Charles de Kock. He's a portfolio manager at Coronation and has been a professional investor for many years. He's seen so many things happen, and we're looking forward to him sharing his insights not only about this year that has been and what a tumultuous year it has been, but also looking ahead and taking a stab at what may happen in the next decade or so. Charles, welcome to the Celerity Investments Roadshow, and thank you for sharing your views today. I think, as just by way of introduction, if you could perhaps set the scene from a global macro point of view, what has happened this year and what may follow?
Right, thank you very much. I must say that in your introduction, you said I've seen a few crises in my time, and that's true. But a major pandemic is the first for me, hopefully the last one as well. And by the way, I did get COVID sometime back in early June, but I wasn't particularly sick and I recovered very quickly. So I can say I've earned my stripes in this one. In terms of the global economy and the impact of that on markets, we quickly talk about that. Certainly nothing in January made us think that we were going to have this sort of a crisis, but it came upon very quickly. And governments reacted in a very, very authoritative way with cutting interest rates to zero and massive fiscal stimulatory policies as well, so that the stock market firstly went down on the news of the lockdowns and then jumped massively on the news of the stimulus. So it was sort of a tug of war between the pandemic and the hardship it causes on the one hand, but the market always looking forward to better times ahead and how that has turned out. So we had a very sharp downturn in March, especially severe, but then a pretty rapid recovery thereafter. So at the end of March, it looked like night in the markets. It was dreadful. Stock prices were down, bond yields were up. It was just mayhem. And then it improved dramatically from there. And now where we are in November, we've just had the US election, and the market is rallying very hard on the news that Pfizer has a vaccine available as well. I'm trying to move a slide on, but it doesn't seem to work. Trying to get to a slide, but you'll have to bear with us.
While you're looking for the slide, Charles, perhaps if I can come in with a question.
Okay.
Obviously, global governments have been very aggressive in their fiscal stimulus, but that has caused huge levels of new debt to be created. What is the consequence of this sort of $12–13 trillion fiscal stimulus package around the globe?
Yeah, no, that's a $1 million question, and one that we grapple with as well. For the developed markets, all of them, the US, UK, France, Germany, all of them, they've expanded their balance sheets dramatically. So the fiscus will have a big shortfall in revenue as the economy is ground to a halt. But those developed world economies can still borrow at very, very low rates of interest. So they seem to be okay. I don't know that it'll last forever, that you can borrow at almost nothing. But while you can, you seem to be okay. For the emerging world, it's different. We can't borrow at almost zero. Interest rates are lower than they used to be, but we still have to pay a reasonable rate on government debt. So for the emerging world, it is worse than for the developed world, where they have the luxury of being able to borrow money at very, very low rates of interest. So we've covered most of these points that I have on the slide there, but certainly you had sort of synchronized global recession in the early part of the year as most economies around the world went into lockdown. You now have something of a recovery. In Europe, they are into the second wave, so there's more lockdown coming there as well. But again, the more developed world will seem to go better with that. The impact on debt, especially for emerging economies, is dreadful. But if we just look at the slide we have here, because it deals with how to deal with that debt, the only really good way out of it is to grow your way out of it. If you can grow the economy, then the government's revenue will rise, people will spend more money, there's more VAT collected, etc., etc. That'll be very good for equities and bonds, but it's unlikely for the whole world to suddenly go and grow adequately enough. You can hike taxes. That's one way to curb the deficit, but that's an unpopular route to follow, and most politicians around the world get elected on promises of not hiking taxes, in fact, of cutting taxes, which you just saw in the US as well. Government expenditure can always be cut. There's always fat to be cut, but South Africa, there may be more than others. And you can always encourage inflation to happen if you can make it happen. And that will be sort of bad for just about everything other than maybe gold. But some mix of those above things will be around for a while to deal with a big debt overhang. But the term financial repression is what we use for keeping interest rates very low for a long time. And I think that is where we are. So globally, expect low interest rates for a long period of time. And that, of course, is favorable for the pricing of risk assets. So when you think equities are pricey, just put it in context of very, very low interest rates, and therefore decent dividend paying stocks we think will be still the place to be.
Just a question on that, Charles. It's clear that from a fiscal and monetary point of view, it makes sense to keep those interest rates quite low. Is the danger not there that governments will react too late if there's any inflation coming through the system?
Absolutely. Again, that's a smart question, and that one that we just don't know. And so far, if you go back to the global financial crisis of late 08 and 09, a lot of observers expected inflation to happen with a zero interest rate policy and QE. That was sort of new policies that were used at the time, and inflation didn't happen. So it's 10 years later now, and you haven't had inflation. Now this time around, everybody says, you won't get inflation. You can just print as much money as possible and keep interest rates at zero. But this time around, it is not just the developed world, it's all over. And combined with the fiscal stimulation as well, we are not so sanguine about the prospects for future inflation. So we're keeping a very keen eye out for it. In the near term, it doesn't look like a threat, but longer term, there has to be a price to the massive stimulus that's happening around the world now. And yes, it may well happen in terms of higher inflation, but it's a bit of a longer term worry, not quite a concern just yet.
Let's have a look close to home. We spoke about the global economy. Yeah. South Africa didn't go into this crisis, certainly from a government finance point of view, in any great shape or form. And then COVID-19 happened. What are the consequences locally?
Yeah. There's a slide on your screen now that says, it's been a brutal decade already. Before COVID, we were already going in the wrong direction. Many crises in our economy. The testimony in front of the Zondo Commission just shows you how wide scale and amazing the corruption has been in government. Meanwhile, they kept giving inflation plus increases to civil servants for the last decade every single year, so that our wage bill has just escalated far too high. So that you've had very sluggish growth on top of the problems at Eskom, where we don't have enough power to power the economy and all of those things, and we had the load shedding and so forth as well. So on top of a weak economy with high unemployment, with rising debts, then you got the COVID and the lockdown. So you really, start off, as your introduction was totally fair, in that, you you started off in a poor shape, and now you got carried straight into the ICU, basically. The graph on the screen now shows in the bars below the line, it shows the main budget deficit starting at 2000. You can see from 2000 to about 2008, 2009, the budget deficits weren't too bad. And in fact, 1 or 2 years, we even had a small surplus. Then came the Zuma decade of ever rising budget deficits as the state wasn't disciplined in its spending. And that light green line on the screen is the government debt as a percentage of GDP, and how that was now rising from very comfortable levels of around 20-30% to nearly 60%. And now with the lockdown, the COVID crisis, and revenues really falling apart, you can see how quickly that has jumped. And in our projections, so past that 2020 line that we see on the screen, our projections show that there's not a huge recovery. And you wouldn't expect that because you have a lot of damage to fix up. So we can see that the total debt to GDP, we think will edge closer to 100%, which is a very precarious situation.
So I suppose that the danger is not only the debt to GDP level, but given that we don't have a zero interest rate on our debt, it's also the cost of servicing the debt, because many developed countries actually have much higher debt to GDP levels, but given that their interest rates are so low, they can service it, whereas in our instance, it's not the case.
Yeah, exactly. Japan has had way more than 100% debt to GDP for a long time, but because they've got deflation and very, very low rates of interest, government can borrow money and it doesn't cost them that much. In our case, we don't have that luxury. So again, as I mentioned, for the world, the only really good way out is to grow your way out of it. That's difficult to see. You can save your way out of it. That's easy for a household to do, but for a government that gets elected, it's very difficult to make those tough decisions and not give salary increases and pay nurses and teachers and policemen and so on more every year. So that's tough to do. Finally, you can increase taxes, and there may be a wealth tax or something coming down the line. It hasn't happened yet, but it would not surprise me if we see some sort of additional tax on the wealthy. But the wealthy is a smallish portion of the economy, and it's not going to save the problems of the state. It may help a little bit, though. Then there's, from the modern monetary theory people, MMT, modern monetary theory, which is the new sort of buzzword around the economists, thinking that just let the Reserve Bank print money and buy all the government bonds and force the yield curve down, as though that's a good solution. If it was that easy, I think it would have been tried before. I think that is very likely to end in inflation, especially in emerging economies. Then there's always talk about prescribed assets. Can the government force the savings industry to invest in its bonds? Of course they can. The old National Party government did that for many years, from somewhere in the early 60s. I think it was finally abolished in 1989. And eventually, if none of those things work, you get to a default or a restructuring of debt. When you say, sorry, we just can't afford this debt overhang, we have to restructure it. Now, that is not our base case, but you can't ignore it either. It is a possibility somewhere out there. Greece had to do it following the financial crisis, because they were in a similar sort of a situation, and they had to restructure their debt. So you tell your bondholders then, sorry, I can't pay you what I promised I would. So we'll pay you a little bit, but we won't pay you everything. And that's called a default. And that, as you say, it's not our base case, but one has to be aware that it is a possibility. So
do you think that has led to the reduction in holdings of foreigners holding South African bonds? Because, that's certainly changed over the last few years.
No doubt about it. So your question on the foreigner is very important. Our yields have been very high and attractive, and when we were investment grade, foreigners happily bought our bonds at far higher yields than you get many other places in the world. We don't have a high enough savings rate to fund our own shortfalls here. So it's important for us that the foreigners do come and buy our bonds. And when our yields are high enough, then they buy them. But as we've gone from investable grade to junk status, many foreigners decided that no longer can we invest in this country because the risk is too high, even though the yields are still very high, and they have been selling. So the slide on your screen now shows you the foreign holdings of our debt. And there you can see at some point it peaked at over 40%, maybe 43% of our total debt was held by foreigners. You can see how that's turned down, and we're currently at around 30%. So there's still a substantial holder of our debt, but they've gone from, let's say, 43% to 30%. That's a big drop already. And just in the last week or so, there's been a little bit of buying again, but we can't rely on that. We have to look attractive enough and safe enough to attack the foreign money. So
you speak about being, about South Africa being safe enough. A couple of years ago, President Ramaphosa announced the clampdown on corruption and fraud. And at the time, many commentators thought that was a bit of a pipe dream, but roll forward 2 years and there's been some arrests and some progress being made. Do you think foreigners look at that and watch that closely, the political situation in South Africa?
I think they look at that, but I think that's a lesser of the factors that they weigh. They look more at the overall picture and the fact that the rating agencies have put us into junk status. And if you look at the fiscal arithmetic and you look at just the size of the deficit and how much bonds you will have to issue to service that going forward, I think the real numbers scare investors. Yes, in the short term, I think there's some light at the end of the tunnel in terms of trying to fix what went wrong and making sure that some people pay the price. But a lot of that money has gone out of the system and fled overseas and has been spent on luxury vehicles and Lord knows what else. But there's a lot of money that just disappeared into somebody's pockets and many different people's pockets, that's for sure.
I suppose,
I
suppose if the government raises debt to fund, productive, call it infrastructure or capital investment, that's almost good debt to raise. But if you have to sell government bonds to sort of fund your running of the country budget, that's what the rating agencies are concerned about.
Yes,
anyway, you were
absolutely.
busy talking about foreigners not buying, but rather selling our debt.
Yeah, I think the fiscal situation has just become unsustainable. As you say, we've even borrowing money to fund current expenditure. That's like, if you have to go to the bank and borrow more money because you want to add an extra story onto your house, that's reasonable expenditure. But if you go to the bank to borrow money to buy the groceries at the end of the month, that's not where you should be borrowing for. So the situation has become very, very shaky for the fiscal arithmetic. Our yields are high in comparison to many other countries. We show a graph there where ours look very high compared to so many other countries. And still the foreigners aren't buying into our bonds, they're actually selling. So it must be the risk. They think our risk is just too high. So if we go from the bond side to the equity side, so on the bond side, just to summarize, we still own bonds in our portfolios and quite a reasonable percentage of it. But we don't only own government bonds. We have about a quarter of our bonds are government bonds and 3/4 are corporate bonds, where we actually think the risk of restructuring or default is lower. But if we turn to equities, it's been the strangest market in that the market has been very, very narrow. The graph on the screen now, on the light blue line at the top of the graph, is the caps VIX. No, sorry, it is just Naspers process and mining shares. Just few shares, Naspers Process, and then the mining stocks will be Anglo's, Billiton, the Golds, and the Platinums. And look how they've done. That index goes from July in 2017, starting at 100, and it goes to 209. So you've more than doubled your money in that area of the market. And now the blue line is the capped SPIX, which includes the top line. And then the bottom line, the light green line, is the capped SPIX excluding the top line. And you can see in both of those, you've gone negative. So the broad market has been negative, but in a few stocks, you've managed to get reasonable returns. That's, a very, very narrow market. You've seen similar things in the S&P as well, where a few stocks, the Amazons and the Facebooks and the Apples and Microsofts and Netflix and a few of those have done terrifically well, and the rest of the market not as well. But in our case, it's even more extreme. And
Charles, does that create an opportunity? Does that create an opportunity among those slides? Sorry, not those slides. An opportunity among those stocks that has not done well over the last 3 years. Do you see some rotation of capital from that sort of part of the market that rallied so hard into what now looks like great valuations?
Yeah, we are always on the lookout for those sort of opportunities. And when we build diversified portfolios, we don't think it's prudent to stick all your assets in just one share or in a very, very small sector of the market. We think it's better to not have all your eggs in one basket. But it hurts when there's just one basket that goes up and the other baskets go down. So therefore, you struggle a bit in terms of performance. That's why so many fund managers have underperformed the SWIX index in the last 5 years or so, because it's only a few stocks that have gone up. The picture on your screen now is the percentage of stocks that have outperformed the ALSI over a 5-year period. That goes back to, it starts there in Feb 1998. So it's a good 20-year period, 20 year and more. And you can see we're down to about a 20% area. So only 20% of stocks have outperformed the ALSI over a 5-year view. Again, it speaks to just how narrow the market has been. But we've been adding to SA equities during the last few months. We think there is compelling value in many cases. We see very, very strong upside. In fact, our internal rate of return on the market, starting with our valuations today and looking forward 3 years, we think we could do a 28% return per year over a 3-year period. Now, that's unlikely to be that strong, but that is of the very low valuations and with reasonable recovery coming in, what you see you can get. So we have been adding to equities, but the market has become quite small in many ways. There are so many stocks that have now become so small. The whole construction sector, for example, the market capitalization of those companies is tiny. You can't really get any big money invested there at all on behalf of investors. But yes, we still like the global stocks, but there's more and more value emerging in the SA basket as well. So on the
just before you handle the information on that slide, Charles, I think so often South African investors consider going into developed market equities or South Africa, forgetting that there's a whole emerging market sector that one shouldn't miss. And the Coronation Emerging Markets Fund is one of the funds we use in our portfolios. So how do you see opportunities in emerging markets outside of South Africa?
Yes, I think it's our emerging market fund is quite exposed to China and other Asian economies. So if you look at that fund, it has very little in SA and very little currently in South America and so on. It's heaviest in China, also a bit in South Korea, a little bit in India and so on. So we like those regions better because of their higher economic growth. And we find very favorable companies there, favorable valuations, and economies that can still grow and are still growing. China is still going to, they've come through this pandemic in a sensational way. And they were first in, but they first out as well. because they locked down, got the people to stay indoors, wear masks as they have been doing for a long time in any case. And they're strongly on the recovery. Taiwan as well, and a number of those other Asian economies have handled the pandemic far better than the Western world. So certainly the emerging markets is a place to look at for many companies where there's still far bigger population growth and economic growth. In our own market, on the resources side, again, dependent on China. Commodity prices are very dependent on the Chinese economy, but we find in the platinums like Impala, Northern that we own, and Anglo American and Exxaro, which is mostly coal, but everybody hates coal now, but because everybody hates coal, it's actually, Exxaro is a very cheap share for us. We think it makes very good investment for our funds. On the global stocks that are listed on the SA stock market, that is still where the bulk of our focus is. And Naspers Prosus are the big ones, but BTI, Anheuser-Busch, Aspen, Bitcorp, and a few of those we like. The Naspers Tencent I've mentioned, they're the biggest shares in our portfolio. And on the SA side, the SA Inc., as we call them, it's largely the banks. We have very, very well-run banks. Yes, they're all going to not pay dividends this year to shore up their balance sheets, but the news coming from the banks are that their bad debts is actually not as bad as expected. Life insurers, we think, are exceptionally cheap as well. And then selected retailers. Foschini is probably the one we like the best after having bought Jet for a bargain from Edgar's. We think they are trading somewhat better than most of the others. So there's some shares in the SA Inc. space that we can buy.
Charles, just before we take a bit of a look at what may lie ahead, two questions we often get from investors, and certainly in this year we got plenty of those, is should I move into cash? That was the one question. And the second thing, looking back over the last decade, global equities have done particularly well in Rand terms. So the second question we get is, should I not move everything abroad, everything offshore? Your comments on those two, is now the time to move into cash, or is now the time to move into global equities?
Yeah, I think that's my first reaction to that question is don't move everything into anything. Always diversify your holdings. Don't have all your money in SA. Don't have all your money in one other place. Spread it around. Don't have everything in one currency. Don't have everything in one sector of the market. But yes, I think for looking longer term ahead, I think the global economy is going to do better than the SA economy. I think we're going to lag in economic growth terms as we have lagged for the last 5 years for lots and lots of reasons that it's too complicated to go into here in a short period of time. But in the SA market, you can have access to many global companies that, like British American Tobacco, Anheuser-Busch, Naspers Prosus, they happen to be listed here, but they don't have anything to do with the economy really in terms of where their earnings come from. So you have, although they are JSE listed companies, their fortunes depend on the global economy. So we still like those. And we think, yes, you should have the reasonable percentage offshore. In our balance funds, we are sort of 25 to 30% offshore in any case. But added to the global companies listed here, the overall exposure of the portfolio is way more than 50% to offshore. Your second question on going into cash. Cash would have been a very smart move in February this year to go into March. You should have had cash in March and never again. Since then, cash is going to give you a very, very low return. Money market now it's sort of below 4%, maybe 3.5%, and globally it's going to give you just about 0. So yeah, I think we can do better than that. But when there was a big crisis like in March this year, when the markets fell 20 and 25 and more %, then of course cash did better than anything else. But to try and be smart and know exactly when that's going to happen, well, even the professionals don't get that right. So we think it's futile to try. So I wouldn't put all my money offshore, and I definitely wouldn't put all my money in cash either, especially when the yields are as low as it is now.
Let's look forward to what investors can expect over the next cycle, the next decade. What should the investors look forward to?
Okay, so this is the part where we get a bit more hazy because looking forward is far more difficult than looking backwards. But looking forward, just one sort of table there. If you look at the asset classes there from SA equities to global equities down the line there, and we have the earnings, the real return versus will it be greater than the target? The T stands for the target. In the case of equities, bonds, global equities, SA bonds, property, commodities, we give them a favorable mark. We give a tick there for all of them. We think they can beat the targeted return of, let's say, inflation +3 or inflation +4 or inflation +5. We think they can all do that. Some with higher risk, like property, we colored that in red because it carries higher risk. The amber ones, the sort of orangey ones, there's some risk there, but worth taking. But SA cash and global bonds are the two where we think you will unlikely beat your targeted return. Global bonds, because starting at virtually zero yields, you can only go one way, and that's higher, and that's negative for the price of those. And SA cash, yielding only about 3.5% and likely to remain more or less there. Well, inflation will probably average, 4 to 5% as opposed to 3%. So it's currently at a low. So in most of the asset classes, we think you should be able to beat inflation +3, 4, 5. And then it's up to your fund manager to make the best selection of the stocks and the bonds within those various classes. But given the low level where we start from, we certainly think that in the SA market, the return possibilities there. Globally as well, I think all that stimulus given is going to lead to a recovery. And we saw just in the last week or so, with the announcement from Pfizer about the vaccine that looks very favorable, you could see how suddenly stocks that were absolutely downtrodden, like the global airlines, they all jumped sort of 20, 30% in a day. Now they're not starting to fly yet, but it's just an issue that looking forward saying, hey, there will be a time where things normalize as well. And the airplanes and the hotels and the tourist destinations won't be empty forever. So off this very low base, we think it's very reasonable to expect that you will get inflation beating returns.
Charles, just a quick question before I give you an opportunity to share your final thoughts with us. It seems quite clear that we'll have a Biden presidency in the US. What does it mean for markets, if anything?
Yeah, difficult to know. You need to know two things. One is who's going to win, and then how the markets will react. And although Mr. Trump doesn't know that he's lost yet, but we all think he's lost. But the fact that the Democrats didn't win a clean sweep, the markets seem to like that. So they say that whereas if the Democrats had won the Senate and the House and the presidency, then they could do more different things and hike taxes more and so on. Whereas with the Republicans still in control of the Senate, they won't be able to get as much through as they otherwise might have. So we think that the more liberal wing of the Democratic Party has been stifled and therefore won't be able to get their sort of more socialist agenda through. So the market is actually quite encouraged by the outcome so far. Although Mr. Trump is disputing the result now, the market seems to ignore it. And so we think he's being a little bit childish, actually. In previous recounts, they often find a few hundred votes here and there that should have gone the other way. But you're going to have to find hundreds of thousands, of a few million votes here and there to make a change. It seems very unlikely. So, I think in my opinion, and this is purely a Charles de Kock opinion, nothing about Coronation's view, but I think Biden will be a more predictable sort of president in terms of foreign policy, and he's unlikely to scare the markets by tweeting at 2 a.m. in the morning something that's just popped into his head like Mr. Trump has done, although we've sort of gotten used to that as well. But I think he's going to be a one-term president because it's just of his age. So in 4 years' time, you may have another change again. But it shouldn't matter that much. By that stage, the global economy should be rising and things should be looking up.
Yeah, brilliant. Thank you. Let's move on to just your concluding thoughts.
Okay. Just
The
total
markets
final
and
thoughts.
whatever is good.
Yeah. Total final thoughts. Boy, this has been the strangest of year ever. Pandemic. It should have been not expected. It can always happen, but the way the governments reacted to it in terms of economic lockdowns was out of the box in terms of expectations. We think that in the world of very, very low interest rates, investors will have to look elsewhere outside the money market and bonds to find returns. Therefore, you'll have to take on some risk in your portfolios, things that you think may be risky, but boy, keeping your money in the bank at virtually zero can't be the solution. So we think you have to trust your fund managers, your advisors, mix it up, have some of your money in various markets and currencies, and I think then you will be able to do well and beat inflation.
Thank you so much, Charles, for your views. It's been a great privilege to come and interview you here from your offices in Cape Town. And what we're going to do now is open up the floor for questions, hand back to our producers. And Charles, as I said, thank you for the opportunity and all the very best. May some of the good news and good views that you've shared come true in the next decade. Thank you very much.
Thanks very much. Thanks all.